be aware of aggregation rules. You may have heard that you can choose to take your RMDs from each account, or you can just choose to take them from one. So that is possible. Let's just say you have 3 IRA accounts you have with 3 different advisors or 3 different companies, and you would then add up each account, calculate what the total is, but you could then choose to just take it from one. But that rule does not apply if you have any company retirement plans or 403(b) plans. Those cannot be aggregated.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This week, we're going to address 7 things that you need to know about required minimum distributions, or RMDs, as they're known. And I received a few questions recently addressing required minimum distributions, and I wanted to go over those as we begin the year. It's generally something that I deal with at the end of the year because you do have until the end of the year to satisfy your required minimum distribution, but you don't have to wait until the end of the year. You can actually start at the beginning of the year. So I want to go over these 7 things that you should know. So number 1 is, what is an RMD? Well, an RMD is an amount of money that the IRS requires that you withdraw from your retirement accounts at a certain age. That age used to be 70 and a half, and it's now 72. So whenever you turn 72, by the end of that year, you have to take out a certain percentage from your retirement accounts. So prior to 72, it doesn't apply, but once you reach 72, every year thereafter, you have to keep withdrawing money from your retirement accounts. The only type of retirement accounts that you don't have to do this for are Roth retirement accounts, a Roth IRA, or a Roth 401k. So number 2 is, how is it determined? Well, it's based on the prior year-end balances of your retirement accounts. So if you have to take RMDs or you're turning 72 in 2022, you'd first want to gather your statements from your retirement accounts as of the year-end 2021. Those balances are what will be used to determine how much you have to take out. So that's step 1 in that process. And then step 2 is that you then use one of 2 charts or tables that the IRS provides. The first one is called the Uniform Lifetime Table, and this is if you're single or you're married to someone and your spouse is not more than 10 years younger than you. Then you'd use this uniform table, and I'll put a link in the show notes to the uniform table. And the second one is a chart for people whose spouse is more than 10 years younger than them. That's called Table 2. That's a much bigger chart because that looks at your age and your spouse's age each year to determine. The uniform table uses the same amount for everyone. So if you're 72, there's factors on these tables. So the factor for 72 is 25.6. So what you would do is you would then add up all your retirement accounts. You would then divide by 25.6, and that would tell you the dollar amount that you need to take out from those retirement accounts by the end of the year. Another way to look at that is to just divide that factor by 100 to determine the percentage. So if we use 100 divided by 25.6, that gives us 3.9%. So that's the percentage that you actually have to take out at 72. That factor keeps going down, which then keeps increasing the percentage. So the factor for 73, for example, is 24.7, so that's about 4%. Let's just say you are married to someone who's more than 10 years younger than you, and you're 72, and your spouse is 61 this year. If we look at that factor on the table, it's 28.1. So that divided by 100 just gives us 3.55%. So we could see it's a slightly smaller percentage. So number 3 is, be aware of aggregation rules. You may have heard that you can choose to take your RMDs from each account, or you can just choose to take them from one. So that is possible. Let's just say you have 3 IRA accounts you have with 3 different advisors or 3 different companies, and you would then add up each account, calculate what the total is, but you could then choose to just take it from one. But that rule does not apply if you have any company retirement plans or 403(b) plans. Those cannot be aggregated. So you could aggregate all your IRAs, including traditional IRA, SEP, and Simple, and then just choose to take a distribution from one of those, then you would have to aggregate any company retirement plans such as 401ks and 457 plans. Those you could aggregate to determine what you need to take from them. And then if you had any 403bs, those could be aggregated. But you can't cross these distributions together. So meaning that let's say you have an IRA and a 401k, and you really didn't want to take money out of your 401k. It was an investment that was doing great for you. Unfortunately, you have to take a distribution from your 401k and from your IRA. So I see people run into trouble with that, and even advisors can get confused with that. So it is a reason why a lot of people in retirement will roll over old 401ks and 403bs and 457s into an IRA, preferably one IRA or at least an IRA with one advisor or one custodian. That way someone can track these for you. Because what if you don't take the money out? Then there's a 50% penalty that the IRS imposes. That's 50% on top of any taxes that you owe. You definitely don't want to pay a 50% penalty on that. And there are people that do every year, unfortunately, because they overlook doing this or they mess up the calculation. So this is where getting some help from your accountant or your advisor can be helpful. The fourth thing that you should know is what can you do with the money? A lot of times people think, well, I have to take this money out, so I have to spend it. That's not the case. You definitely have to take it out and pay taxes on it. And after that, it's up to you what you want to do with the money. The IRS doesn't really care. They just care that the money comes out and that you pay tax on it. So the money could be reinvested. What I sometimes have clients do if they don't need the money now is to reinvest it in a taxable investment account. That is one option. Or, even better, I love when my clients spend the money, right? You can't take the money with you. And a lot of people, I would think over the last couple of years, have not been traveling, not been doing as much. So maybe they haven't been spending this money, but I encourage you to consider if it's within your budget and if it makes sense to consider using that. The fifth thing to know is, can this RMD be avoided? Well, as the old saying goes, there's two certainties in life, death and taxes. And this would fall under the taxes category. No, it really can't be avoided. The only way to delay it is if you keep working in your current job and have some of your money in the 401k plan through that company or 457 plan or 403b, then you can keep your money in there and work past 72 to delay the distribution. But once you retire, the year after you retire, the distributions would have to begin. The only way you couldn't do this is that if you're working for that company and it's your company, or you're more than a 10% owner in the company, then you wouldn't be able to delay your distributions past 72. But if, let's say, you're still working into your 70s and you love your job and that company has a 401k plan, you don't really need the money from your IRA accounts now, you might want to consider rolling those over if your current 401k plan allows rollovers, and putting that into the 401k plan while you're still working until you retire. That way, the money can stay tax deferred. You don't have to pay tax on this money, and it keeps growing for you. So the sixth thing to know is, how is this money taxed? Well, it's taxed as ordinary income. What that means is that whatever your distribution is for the year, you'll add that to any other income that you received from the year. So many people that are attaining age 72 are receiving Social Security. So you add this to your Social Security. If you have a pension, you add this to your pension. If you have stock, dividends, or bond interest that you're receiving, you add it to that. If you're working part-time retirements. So you add all this together to determine that. Rather than waiting till 72, it could make sense for you to start taking distributions out before that. I've mentioned this in other podcasts, that it could make sense for you to start before 72, depending on your other income. It's a great thing to let this money grow and let it accumulate, but the negative is that if you wait all the way until 72 and your money is done well for you, you've accumulated a large tax bill, essentially. You most likely will have to take more money out at 72 versus if you started taking the money out at 65 or 66 when a lot of people retire. Then you might be able to pay less tax in those early years on the money, and then you'd have less maybe to take out once you reach age 72. The seventh thing to know is, how can these taxes that you have to pay be reduced? Well, I mentioned one way earlier is that you could start taking out the money before 72. Another way is that you could consider what's known as a qualified charitable distribution, or QCD. That is a way that you can donate part or all of your required minimum distribution to a charity of your choosing or to multiple charities. And this is limited to $100,000 per year per person. So if you're married, you and your spouse could donate your RMDs up to $100,000 each. And if you do this RMD, let's just say you had an RMD of $20,000 and you donated the entire $20,000 to multiple charities, that $20,000 is no longer taxable to you. So that's one way to eliminate the tax. Now, you no longer have the money, but if you're somebody who's charitably inclined and normally you donate money to charity, this could be a way to do that. This can be any 501c3 charity. So you definitely want to check and make sure that the charity qualifies. And where I see people mess this up is that you have to contact your financial institution and fill out their paperwork so that they send the money directly to your charity. You can't take receipt of the money and then send it to the charity. It doesn't work that way. So every company has a form that you fill out with the information for the charity, and then the money goes directly to the charity. And then at the end of the year, you'd receive a 1099 that would show that the money went to the charity, and it would show that it was not taxable to you. For a lot of people, this could be a big thing to look at, because one thing that's gone away for most people recently is the ability to itemize your taxes. Many people, especially where I'm located in Connecticut, the higher tax states can no longer itemize. And I mentioned a few episodes ago about using a donor advised fund. That's one way to be able to donate to charity, but this is the other way when you reach age 72, because if you're donating, let's say, $2,000 a year to charities, you're only able to write off up to $600 of that per couple. Whereas here, you could write off the whole thing. The whole $2,000 comes from your RMD, goes right to the charity, then it satisfies part of your RMD, and then it also helps the charity. Another thing to consider once you reach age 72 and you start taking out these distributions is that this money plus your other income might subject you to additional cost for Medicare. And there's something called IRMA, which is an additional monthly adjustment that you have to pay for Medicare. And I mentioned this in episode 31, Avoid Overpaying for Medicare. And that's for an individual if your income's over $91,000, and as a married couple filing jointly if your income's over $182,000. So this is a way that you could donate part of your money to the charity through the QCD, and this could then reduce your income, helping you to avoid this. So I hope this was a good refresher on RMDs. If you have a listener question, you can ask your listener question by going to retirewithryan.com. Then towards the bottom of the page, clicking on the contact form and asking your question, and I'll consider it for a future episode. Have a great week, and I look forward to talking with you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.